We are thrilled to have the opportunity to be the first panel and with some big powerhouse players that I am lucky enough to actually call friends as well. Ryan and I used to work together at Fidelity Digital Asset Management, and then we also have Blue Maslari at T. Rowe and Catherine Dowling at Bitwise. So why don't you all just take a few minutes to introduce yourselves, tell us a little about yourselves.
Sure, I can start. Thanks again, Jessi, and thanks everyone for having us. Ryan Lessard, digital asset strategist, as Jessi mentioned, with Fidelity's digital asset management division. That's one of our two commercial businesses at the firm. I've been a part of this team since early 2021 and saw a lot of the early learnings and journey together with Jessi, and we'll call it the innovation that has now fostered a commercial market in the last few years. But as a digital asset strategist, I represent Fidelity's capital markets outlook around this asset class to a wide variety of clients, and then, of course, our product and service offerings.
I'm Blue Maslari. I'm head of digital assets at T. Rowe Price, and I'm responsible for operations strategy implementation from both an investment perspective and in terms of tokenization.
Good morning. Pleasure to be here in the great state of Texas. A big thank you to the courts of Texas that have been a big part of pushing the digital assets forward. That's been a huge, huge push. We were reminiscing backstage, Catherine Dowling, Bitwise Asset Management, about the spot Bitcoin and spot ETH launches that all of us had been a big part of, and looking forward to what's next. So here we are talking about the digital asset frontier. It feels as if those are kind of now mainstay, and we can talk a little bit about kind of what's next on that frontier.
Yeah, a lot has happened over the last 18 months. So from your vantage point, what's tipped the scales?
Obviously, the administration change has been a huge, huge push. In fact, I was at an event on Monday, the Fordham Policy event, and Chair Atkins came to that event, which actually a number of the regulators came on their own recognizance because of the shutdown. Just that fact alone, that they made the effort to come despite the shutdown and speak to a crowd of all crypto folks about what they're seeing, what they're doing, and the steps that they're taking. There was a fireside chat with Atkins about kind of building on his Project Crypto speech themes. And talking about moving forward. So obviously we have Genius out there, which is fantastic, and thank you for that announcement. That's very exciting and needed. But Genius is kind of the beginning. It means that we now have more work to do in terms of actually defining, getting kind of the rules of the road clarified. And I think that tied into what Chair Atkins was saying on Monday about the promise of DeFi, and that's what I'm talking about, the next frontier. This is really just the tip of the iceberg, but DeFi is really the promise. But to get there, we have to do it in the right way. So it's, as he in fact said, we don't want the Wild West that Gensler warned about so much, and the way we get there is how we are now working with the regulator, which is regulation by relationship instead of regulation by enforcement. So what we're seeing is a lot of dialogue and a lot of invitations to come in and speak to the regulator. At Bitwise, we've been in a number of different times helping with the work on the generic listing standards, which is a huge push to allowing more ease of entry for the digital assets in the ETF wrappers, so that it's not going to be this bespoke process where each time it takes, umpty-ump number of days and a lot of back and forth for each one, establishing just foundations where if you can clear those foundations, it's a much easier automated process. So I think that's a huge push forward as well, and that's been a big part of the dialogue with the 100 potential issuers for the beyond Bitcoin, beyond ETH ETFs, which will be great for the ecosystems for each of those digital assets, but a good starting point.
Absolutely. And speaking of ETFs, that's kind of the first product to be out there, but I know T. Rowe and both Fidelity are looking at tokenization. So Blue and Ryan, can you tell us a little bit more about what your institutions are doing there?
Yeah, so I think something that's always important to note that is that T. Rowe we are one of the world's largest active managers. And so there are sort of other considerations that come into play for us. And when we look at tokenization, one of the things that we have struggled with is if we tokenize a fund, so say we tokenize an equity fund, we have limited use for a tokenized fund if the underlying assets are still settling on legacy rails and legacy timeline. So if you have the actual fund settles at the pace of blockchain, speed of blockchain, and every single stock underneath is T+1 legacy rails with the potential errors and trade reversals and all that, you are building basically a consistent intertemporal compounding sort of asset liability mismatch over time. So what does that mean in layperson's terms is that we are very much interested in the progress that we're seeing towards tokenization of underlying assets, and not just tokenization by twinning. So not just internet ADRs where you get an IOU that has the name of the stock sort of printed on it, you can run around the blockchain with it, but native issuance on chain of underlying equities. That is a game changer for us. And this is one of the things that's been really encouraging, and I feel like it all ties into the regulatory conversation at this point, but seeing NYSE and NASDAQ taking that step forward in terms of filing for the ability for tokenized underlying equities, which includes ETFs, is pretty amazing, and we're getting there faster than I thought that we were going to.
Absolutely.
Yeah, we sit in a unique spot at Fidelity as we do both of these things. We do traditional assets on tokenized rails now, and of course, digital assets and exchange-traded products. On the token front, most recently, that I don't even know how much press it's received over time, is we just launched in August an on-chain share class of a money market fund. So we now have a Fidelity digital interest token on Ethereum, and this being, call it, our first step natively as a firm to take a traditional asset and put it on those blockchain rails. I think, likewise to my colleagues and peers on stage, it's really early innings here still, but I can't tell you how many conversations coming from the clients and prospects I face off with have started on this topic area in the last 3 to 6 months alone. So there's a lot of interest in, a lot of need to understand what's going to happen here and when, as this could move really fast, I think, in this regulatory environment, and everyone wants to be prepared, whatever that might mean for them and uniquely their business. So we're seeing it opportunistically for a lot of new client segments that want to interact with Fidelity and consume products natively on chain. And then I think at the same time, working with our traditional clients almost backwards to bring them up to speed where this technology is going.
How are you working hand in hand with regulators as you do this from a compliance perspective? I'm interested to know that.
I'll start. At Fidelity, we're fortunate we have a really large government relations team that is strongly engaged with regulators, with counterparties in the blockchains and digital asset space to foster a lot of this innovation. As you could imagine from Fidelity's point of view, there's a lot that we talk about with these regulators every day beyond digital assets, but we've focused and had a strong focus on specifically this asset class as well. For us as a firm, this really helps us when there's positive momentum on the regulatory front. We want this. And our clients, if nothing else, want it even more. They want that clarity of making them comfortable enough to enter this space, whether, again, it's with buying Bitcoin or another cryptocurrency, or if it's interacting with an asset that's now on token rails.
Great. From a client's perspective, what due diligence steps should advisors take before relying on new state-chartered custodians? How is Bitwise approaching this responsibility, Catherine?
Well, Bitwise works with the institutional clients. So
right.
There is actually always some sort of operational diligence going on because one, they should do the diligence, but two, they have to from
right.
a fiduciary duty standpoint, because if they're going to recommend a Bitwise product to their clients, they have to have gone through those steps. So Bitwise sees a lot of that diligence side around, regardless of which project which product they would like to put their clients in. And obviously, there's always a lot of questions around custody, as there should be. Right. The safety of it, how they work, the different ways that they work. And we are seeing, there are a number of very high quality custodians that Bitwise and others work with. Some folks up here actually also do custody, so I should speak to Fidelity, and Bitwise works with Fidelity as well as a custodian. But they have different ways that they work, and from an operational due diligence standpoint, when Bitwise gets those questions, we will walk them through how the different ones work for the different products. And as that continues to evolve, I would say that will continue and should continue to happen. And then obviously they need to decide whether they feel that the comfort in how the different custodians work, whether it's separate different wallets, cold storage, et cetera, how those different products work, right. Go through each of those steps and show them the different mechanisms that each of those custodians take, whether here or abroad, because they all do have slightly different twists on the mousetrap.
Yeah, this is one of those bizarre ones that I'm super passionate about that probably nobody's really passionate about. But and I feel like this is probably an audience where I don't need to say this. But every time I have this conversation at T. Rowe or with the SEC or in those feedback comments to Hester Peirce's 48 Points of Light, I say over and over again, these are bearer instruments housed on the internet. And so security is the cornerstone. The technology and the security is the cornerstone. And I think in the previous probably 3 or 4 years, this differential between state chartered and the one nationally registered, right, which is OCC, overseeing Anchorage, was blown out of proportion, and a lot of the focus was put on the regulatory sort of status, which is important if you're a financial advisor. And I think that we have sort of seen that resolve itself. But if you are a financial advisor, if you are in a position of fiduciary responsibility for digital assets, for crypto, then security and the technology behind the security needs to be your utmost priority. And then you look at the certifications and the registrations.
But Blue is right, like the question of the regulatory overhang or cloud with regard to whether they met that definition. Right. We're now getting to a much better space so that can be hopefully taken out of the equation. And the focus can now be on more of the operational mechanisms as opposed to definitionally, is this going to work? But they have to be able to check that box as well.
I'd just echo a lot of what Blue and Catherine said. What I would add from the perspective of even evaluation of fund vehicles that have the underlying custodian is when these institutions are going through institutional due diligence processes and submitting 50-page documents for our answers.
50, they're more like 100.
Yeah, they're often even more. 50 is a good day. They're lengthy. And as you can imagine, and I think this is a good thing, as much as due diligence as they're doing on the fund vehicle itself and how that works and all of the mechanics and operations, they're doing equal, if not more, due diligence on the underlying custodian of the assets in a passive fund, right? And so you can see there's a huge focus there, especially given that all of these custodians, more or less in the space, are net new relationships to these investors, right? They might be familiar even with Fidelity as a firm, but they aren't familiar with Fidelity Digital Asset Services, the custodian. So there's a lot of legwork that goes into that, and giving them comfort through that process, whether it's from our side or the regulatory side, goes a long way in getting them comfortable to make an investment.
And there's different comfort levels. If we've seen even areas where posting wallet addresses we thought was very, a transparent move and a very safe move, in Bitwise's opinion. But then you have other diligence investors who think, no, that for us that feels unsafe to publish those. So you kind of try to also meet them where they are and keep everybody happy.
Everyone's not always going to be happy, but yeah, that's part of the journey. Exactly that. How someone views security as a really broad word is going to vary when they start applying it to this asset class.
So we've come a long way in the last 18 months. We started the conversation with that. Innovation and regulation have always been dancing a few steps apart. How do you balance innovation with you all are pretty big firms, with the fiduciary duty when the rule book is still evolving?
Peer benchmarking, doing the absolute best that you can with what you have currently on the books. And it's not always easy. And obviously from an operational standpoint, from a brand standpoint, for your products. You have to do it as best that you can, but innovation is always going to be a couple steps ahead. I mean, take right now, we have staking, looking at staking in some of these ETF products, right? So Grayscale is now out with the ETH staking, which is great. We were not allowed at the outset but we had to put in bold print in the documents.
Right.
No staking in the spot ETFs. Yep. Meanwhile, it's been going on for a long time in other countries safely, and had good. We would show the research of, look, it's working. It's not just ivory tower. It's actually working, but. Now we have some of these products coming out, and there's still an open question as to whether staking in the entities that these ETF products use, the grantor trust, will blow up that status. So, and it's a tax question at heart, and a number of organizations and Bitwise, we've worked with a number of them to try to push on IRS and Treasury to put the guidance out. So where we've seen like the SEC is coming out with guidance, and to be fair, the IRS has come out with some guidance as well. I mean, the recent guidance on corporate AMT with regard to digital assets has been quite helpful for Treasury companies, very helpful. But there needs to be more to clarify that you're not going to have this blow up happen. So you're seeing those products go forward, and how are they going forward? Like I said, with what's on the book. So a number of tax attorneys that have been behind. I think there are like 5 that are working on all of these. So there's only 5 of them, but they're all good, smart people that are saying, okay, here's what's on the books, and here's how we can do it safely. But it's not the most efficient way. Right. We're doing it this way because with grantor trust, it's plug and play. You can't turn it into an actively managed product. And in reality, it would be easier if you could actively manage with staking. So you have to kind of set it and forget it to make sure that you're not. But those products are proceeding with what's currently on the books with a lot of tax advice, et cetera. So they're more costly, they're not as efficient to get out the gates, and then hopefully the guidance will follow. With the government shutdown, it may be a little longer, right. But maybe they're kind of at home working on that in their spare time. So hopefully, but a lot of dedicated folks in those agencies that are also wanting to get this forward, and that are in fact working hard on it.
Right.
All I'd add, as you could imagine, compliance is, a large concern and concept at a firm like Fidelity. And, we're, of course, being cautious with limited rules where we have them and rules as we gain them. But we're being intentional as well and really trying to meet our customers where they are and what they want from us. As the theme of this conversation somewhat is on the due diligence side and, where that institutional adoption is going, it's started, to be clear. Like, that is happening in real time in many different ways, but it's still really, really early. So there's something about not getting over your skis with things that maybe your customers at scale aren't even demanding quite yet anyways. And I think on a lot of these topic areas, we'll get there, right? It's just about when is sometimes someone's best guess, and that's okay too. It's about, in the meantime, for a firm like Fidelity especially, we have plenty of work to do with the limited things that we already have available to us. So it's not for a lack of opportunity. It's filling that in every single day with customers, prospects, et cetera.
Blue, I'd like to talk a little bit about, T. Rowe published the cryptocurrency moment earlier this year, framing crypto as an emerging asset class. What were the turning points that convinced you that it was no longer a tech play, but actually a structural shift for allocators?
That's a really good question. Sorry, I'm
sorry.
Allergies? Sorry. It's a really good question. We look at it on 2 different factors. Okay, can you go to a question from someone else?
Oh, yes.
I'm having an allergic reaction to something.
Sorry. Okay, Ryan, I know that you guys talk about this with clients quite a bit, about how you think about digital assets in a portfolio as an allocation.
Yeah, it's the number one question we probably get these days from investors is, the ETPs, Bitcoin Exchange Traded Products, call it, specifically launched January 2024, they solved the how do you allocate for a traditional investor. Though they could have potentially gone out and bought spot if their investment policy statement allowed them operationally to set up a relationship and do so. But for the vast majority, this wrapper solved the how. So The following 18 months was a lot of the why in talking to investors about that story and that opportunity and the macro thesis for Bitcoin or other digital assets. And as they get through the why, it's now the how again, but how much this time, right? And start to consider it in the context of what they do. So the classic answer is it depends, right? Depending on, first off, what type of investor we're talking to and what considerations they uniquely have. And that goes everywhere back to, are they managing a portfolio on an institutional level for an endowment? And the considerations of duration and time frame are quite different than a wealth advisor and their individual client who could be 65, they could be 25, and they might have 10 years of savings or 50 years ahead of them, and the risk tolerance varies greatly. So a lot of that is it depends. But, based on that, we've looked at it many different ways. You can, of course, look at upside scenario analysis of projecting out return assumptions, and everyone loves seeing that, depending on what it says. Bitwise has done some great capital markets assumptions that I think have been really well received, and we've heard great things about those, in our conversations. And then, we've looked at it sometimes different ways too. Risk-averse analysis, right? How much could I allocate if worst-case scenario this goes to zero, right? And what is that impact to my portfolio? And, again, putting that on the time frame of different clients with different risk tolerances, et cetera. So we approach every convo uniquely, but I think the good news is now is there's institutional quality data on these assets of 5, 10 years, in Bitcoin's case, many, places that you can start to model some of this out. You can start to take a really, call it MPT statistical lens, how they do everything else, with now a new asset to them.
Yeah, so, sorry, I would jump in now and say I think we looked at it very much the same way. So one of the questions that we tend not to answer at T. Rowe is what should be the allocation. We think that's something that's left up to an advisor in their conversation with their client. But the decision to make an allocation, so there are effectively two criteria that we looked at. The first one was, and Stefan Hubrick is our global head of multi-asset research and systematic quant, is a fantastic researcher, and he's the one who published the paper. And actually, if you look at the footnotes, he thanks Matt from Bitwise. Like we got them to coordinate on it and go back and forth and share ideas. And those were some pretty cool emails. But the question was, can this generate, and we looked specifically at Bitcoin and digital assets to a lesser extent, but can they generate an excess return over cash over time? And so we arrived at the answer yes. And we think that there are a couple of components. We think that there is the equivalent of a velocity of money formula and model that can be built for Bitcoin, right? So transactional acceleration. And then the second is, you will all be stunned to know, a macro analysis, what I think has become popularly termed the debasement trade in like the past 3 weeks. But it is effectively, before I moved into digital assets, my entire focus for 20 years was distressed sovereign debt. And I worked on multiple sovereign restructurings, and I did this in EM. And I know what a sovereign balance sheet is supposed to look like, and I know what it's not supposed to look like. And what economists call the exorbitant privilege of being able to print money is something that eventually runs out over time. And so we think that there is the potential for Bitcoin in particular to become an alternative reserve asset. Sure. And in that case, if we have a diversification away from dollar-based international reserves, and if you assume that Bitcoin takes some percentage of that is currently going to gold, you get to an expected positive return over time that's pretty substantial.
Okay, and I would just add that both of you nailed it, absolutely, right? And risk-based, really risk-based, as you guys were indicating. But what's been also really interesting of late, because of the last 18 months or so, is trying to also forecast how these developments are changing up the cycles that we've seen in the past. So we're seeing a little bit of a change in that regard with the prior 4-year cycles. And what we're trying to look forward to is, what does that mean for how we previously looked at forecasts for looking at allocations down the line vis-a-vis relative to gold, relative to other assets, and trying to forecast forward. But we're also seeing that it's interesting to inject now this background with the ETF flows and the changes that we're seeing to the ecosystem, to the growth in the digital asset treasury companies, also the legislative forward motion on reserve assets. All of those are adding to into the flavors that we're seeing, and they're impacting recommendations, and obviously the volatility of the asset and the risk profiles for folks. So that's been extremely interesting to look at, taking it out of, again, academic and saying these are, real world, situations that are impacting this, and of course debasement as well, as Blue mentioned.
That's right. We have about 30 seconds left, so one word to describe the institutional crypto market, each go. Ryan.
I'll cheat. 3 words. Early but encouraging.
Oh,
Faster than expected.
okay.
Changing the rails.
Oh, gosh, okay. Those are all excellent, and I put you on the spot, so thank you for playing along.